Inspiring interviews with today's top landlords. This is the Rental Income Podcast. And now, Dan Lane.
Zach, why do you like buying new construction rentals?
Yeah, Dan, for me, new construction makes the most sense in my investment portfolio because I get a quality asset, an A-class asset. I always look for good neighborhoods. You know, for me, I'm looking for those neighborhoods where there's anywhere from 700 to 1,000 homes that they're building, and there are only about 5 different models that builder's offering. So a lot of cookie cutter, low to mid-grade new construction. And for me, I don't have to budget any maintenance dollars for repairs in at least the first year.
And honestly, probably longer than that. This is a brand new property. Everything in there is brand new. So you really shouldn't need to fix or replace anything for quite a long time. But I'm curious to see if there's a downside, and I want to get to the bottom of, are new construction rentals a good investment? Usually with new construction rentals, you can't negotiate on the price. So you're not going to get a screaming great deal on a new construction property. You're probably going to pay the market price. But the upside, I think, is that they're probably very easy to rent. And I think that they're probably easy to manage because you're not going to have a lot of maintenance and repair issues. It sounds like Zach's buying in very good neighborhoods, so they're probably going to appreciate a lot better than a property that's in a marginal neighborhood. So I want to learn more about exactly what Zach's doing, exactly what he's buying, and I want to take a look at his numbers. Joining us on the show today from Austin, Texas is Zach Hjornevik. We'll take a really quick break to thank our sponsors. We'll come right back and we'll talk to Zach. A good deal on a rental property isn't going to last very long. To win properties today, you need to move quickly when a deal comes on the market, but it takes time to analyze a property. I want to let you know about an app where you can analyze deals on your phone in seconds. It's called Ask Rick, that's RIC for Rental Income Calculator. You can analyze a deal with the push of a button. You can figure out the rent, your mortgage payment, your expenses, and figure out the cash flow. If the numbers make sense, you can make an offer right there on the app, or you can send a calendar invite to your agent to see the property in person. Ask Rick is currently offering a free 7-day trial. Just search for Ask Rick in the App Store or go to Just Ask Rick. That's RIC, justaskrick.com. It's a lot of work to find a really good rental property, and when you actually find that property, you want to make sure you're working with a lender that can get that loan closed. The lender that I recommend is Chaley Ridge from Ridge Lending Group. She's a nationwide lender, and her specialty is helping investors finance rental properties. She has a ton of loan programs, and she can find something customized to you for your situation. If you want to find out more or you're ready to get started today, just go to ridgelendinggroup.com. That's RIDGE lendinggroup.com. NMLS 42056.
Rental Income Podcast.
Zach, I know that every area is different, but a lot of the new construction that's being built across the country today are nicer properties. They tend to be bigger properties, and they're in really nice neighborhoods. Is that what you're buying?
Yeah, Dan, I would say they are in nicer areas, but I don't want to invest in an area that I would consider already developed. For me, I'm more focusing on future growth and future development in the neighborhoods that I'm investing. So I want the Starbucks coming soon, the grocery store coming soon, the healthcare facility coming soon, not established, because when they're established, you're paying full retail on the growth of that market already.
That makes sense. So the areas where you're buying in, there may be outlying areas where the development hasn't quite come yet?
That's correct. And so for me, what I key in on is access to major freeways. I like to have a decent school district. I mean, I'm not looking for the top school district because, again, you pay a premium for that. But I'm also looking for what I get excited about is when I see 10 brand new construction developments all within a 20-mile radius. It doesn't matter what the existing product in that area is because the appreciation of those 10 brand new neighborhoods are going to drive the prices and that market moving forward.
Right. Okay. So you see a lot of new development. I mean, this is basically turning into a new town. is kind of what you're
Correct.
looking for.
That's exactly correct.
So
Yes.
now, from what I've seen with new construction, when a builder starts building, they kind of set the price. And then as they start selling more houses, they typically try to raise the price, I don't know, maybe 5 or 10 grand or something every time they sell a few houses. Is that what's going on in the neighborhoods that you're buying in?
Yeah, Dan, I'll give you like a standard neighborhood. Let's say it's 1,000 homes. There's going to be 5 different models and maybe 3 different phases. And so when you look at a neighborhood with that criteria, I'm only interested in that neighborhood if I can get in at the beginning of phase one. And so I've got many examples in this past year where I bought a property in the low twos that they're now selling that exact same model, that exact same floor plan for the high twos less than a year later. So I'm getting that forced appreciation. And for me, the reason builders do that is they want to get those initial sales to escalate that neighborhood and get that value into that neighborhood. But as they complete phases, as they complete streets, then the prices can go up because not everybody wants to live in a construction war zone.
Right, right. Now, how about finding tenants? I mean, when you have that construction war zone, is it hard to find tenants that are comfortable with construction going on all the time?
Dan, it hasn't been an issue yet, and this is honestly the biggest appeal to me of this model is that I've had tremendous support from the sales reps that I'm buying these properties from. And it's such a unique model, and I just kind of stumbled across it. But I go into a neighborhood, they allow new construction investors, which is rare in this market right now. Not all builders are allowing this. And so I buy a couple properties, let's just say on the same street. And the sales rep, whenever somebody else is coming in and they want to buy a home, if they don't qualify for any reason, maybe it's credit score doesn't meet their criteria or they don't have the income necessary to purchase, that criteria might be okay for me, but it's not to get a true conventional loan. And so I have this sales rep at the builder that's actually providing me what I consider very qualified tenants that I'm able to sign up. They're getting the house that they already wanted to live in. And so it's just they just don't own it and they're renting it from me.
Yeah, that's really smart. Okay, so the people, they want to buy the house, but for whatever reason they just can't get approved, so they'll rent the house that they would like to buy.
That's correct. And a lot of these individuals have the hope of buying one in that neighborhood after a year or two. And again, if they do, Dan, I'm very happy for them. I don't want to hold anybody back in that aspect. But what they don't know and what I do know is that house that they want right now and can't qualify for at 229 is probably going to be worth 289 in a year.
Right.
And
right.
so it makes it tough.
Right. Now, I know that a lot of builders don't like selling to investors, but it sounds like you found builders that they have no problem selling to investors.
Yeah, in this market, because of what has happened in the past year, with the past 2 years with the pandemic, most builders have tried to slow down, if not reduce or eliminate investors in their neighborhoods. And so when I find a builder that allows that, it is extremely important for me to build a relationship with them, not only for clients that I represent as being a realtor, but for me as well on the purchasing side.
Now, have you seen a lot of other investors buying in the same neighborhood?
Yeah, there was one neighborhood, Dan, that I have in San Antonio that I personally own 2 houses, and I've brought in 2 other investors to purchase there as well. And honestly, I was a little disappointed because after I was under contract, I noticed that large organization Fundrise had purchased 100 units in that neighborhood. And so initially, I was really concerned that there was just going to be too much competition for me in placing tenants when I'm competing against a large organization
Right.
like that. And with there being that many rentals in that neighborhood if there would just be oversaturation.
Yeah.
But what I was really, what I've been happy about is that I actually self-manage, or my wife self-manages those properties for us. And so Fundrise is having to charge those management fees on top, whereas I don't have to charge that. So I'm able to come in slightly lower than what they're requesting for rent, which has made my vacancy next to nothing.
Yeah. I mean, that's something to think about because you figure if they own 100 properties, they're really setting the market, which could be good or it could be bad. That if they decide to drop rent, they really have a ton of units that they're dropping rent to. But at the same time, if they're really pushing the rent higher, that could benefit you.
For sure. And from my initial experience, they've been reaching significantly higher for rent than what I even needed to be at to be profitable.
That's awesome. I love it. Now, let's talk about inside the house. So are you doing a lot of the upgrades inside the house, or are you making them more like rental grade?
So for me, when I look at a new construction investment property, I do not have any, I'm not buying in neighborhoods where you even have the option to do upgrades.
Okay.
Where they're basically saying, if you want this house, it's on this lot and it'll be completed on this date. Take it or leave it. And so that's
it.
The low to mid grade new construction is that sweet spot where if you go too custom or if you go too many upgrades, you're just pricing yourself out. And I don't often see the return on extra lighting or upgraded floors on your rental income.
Right. Absolutely. Now, one thing I've noticed in my area where I live is that new construction kind of sells at a premium. Where I mean, I don't know how the builders do this, but they're selling new construction houses for more than you would buy for like a resale house. Is that happening in your area, or is that just local to me?
You know, I would say that I've paid full retail for just about every property that I've purchased. I haven't had any that have not appraised. But I think what's unique about this, Dan, is two things. Is that one, you have to be one of the first buyers in the neighborhood so that you're not paying more for a house that sold for $30,000 less 90 days ago. But I also think one thing that's underestimated in this model that I do is that I'm able to find out what the exact houses that I'm buying have just appraised for. And so that's because they've sold other models prior to me. And so I know this model just appraised for this amount. Therefore, I know that appraiser is going to have that comparable, and I will hit that appraisal number.
Right.
And so you just have to kind of trust in that process. But I have not had any experience with them not appraising, but I'm very early in the acquisition on these new neighborhoods.
And so then as you buy a property in the neighborhood and then as the builder starts pushing the price up, have you continued to buy in those neighborhoods, or is that when you just look for a new neighborhood?
I can't bring myself to do it. Once I've paid $229 for a property, I cannot bring myself to buy that same property at $249.
Sure.
I have to go move to a different area. But I believe strongly in having investment properties in clusters. And so for me, when I buy one house in San Antonio, my wife and we know we're going to buy 5 houses in San Antonio because it's all about having systems and processes and that team surrounding you. And so it doesn't make any sense for me to buy one in Houston, one in Austin, one in San Antonio, one in El Paso. That's 4 potential property managers, 4 different people I have to call if there's plumbing issues, if there's any kind of repairs or maintenance. So I believe strongly in clusters. And then as I hit the 5 properties in a market, then I'll shift to a new market.
Let's take a look at the numbers of one of your deals and see how this is working out. So say for one of your recent purchases, what did you buy the house for?
Yeah. And so And before I get into that, Dan, what I think is important and that I don't hear a lot of investors discuss is when they close on a property. And so for me, it is very important that I close on a property at the very beginning of a month. And so, for example, I close on a property, this property that I'm going to be giving you the numbers, I closed on January 3rd, 2020. Or 2021, excuse me. And so when I close January 3rd, 2021, I don't pay any mortgage January. I don't pay any mortgage February. My first payment is due in March on that property. So for this example, the home price was $229,900. The rent that I was able to get on this property was $1,750. And so, Dan, I'm not pursuing the 1% rule, the 1% of the purchase price for rent. That's not achievable in new construction or, quite frankly, in a lot of the markets that investors have been accustomed to that 1%. I look for anywhere between 0.65 and 0.75 is the ratio that I'm looking for. This one specifically is 0.76, and so I considered this a very successful deal for me. And so day one, I knew exactly when I was closing on this property. So when I closed on it, I received a $3,500 check from the tenant. So I sign and literally hand the keys over to the tenant on the same day. So $1,750 of that is security deposit, and $1,750 is the rent for that first month. Actually, be a little bit less because of prorating since I closed on the 3rd. Month 2, so that would be February. I get another $1,750. Still have not paid a mortgage payment at this point. And so then when I get to March 1, that's when my first payment is due. But at this point, I've already accrued $5,250 from the tenant. If I extract the security deposit, I'm up $3,500 at this point for the year, and this is only 90 days in. And then that property cash flows $250 per month right now. And so in the first year, I am positive $6,500 on that deal. And that's just cash flow from that property. I'm not budgeting for maintenance, at least in the first year, because anything new construction would be managed, any repairs would be managed by that builder. And that doesn't even account for any of the other ways that investors make money, whether that's through principal pay down, tax benefits, et cetera.
Yeah, I mean, some people, you mentioned the 1% rule earlier, and some people might say, well, if it doesn't meet the 1% rule, I'm not going to buy it. But in your case, this is a brand new property. So, I mean, you've got to put some premium on that. And I think you've got to be flexible to come off the 1% rule because you're getting a brand new house. But then also, like you said, you don't have any maintenance because everything is brand new. I mean, there's nothing to worry about. So, like, have you had any maintenance stuff come up at all?
I have. I mean, it's minor stuff in a new construction house. I mean, minor electrical, minor plumbing issues, but it's as simple as calling the builder and they go over and fix it.
Right, because it's under warranty,
I don't
right?
have to do anything.
You've got a 1-year warranty.
I do. That's correct.
Awesome. Now, one thing you've been able to do is pull cash out of some of the properties that you've bought. And is this because the properties are appreciating so much? Is that how you're able to pull out the cash?
You know, I think it's dangerous to focus too much on appreciation as an investor. But I also, somebody that owns a house in Memphis that, I bought for $75,000 and after historic appreciation is worth, low 80s. So it's seen minimal appreciation, and having something in and around Austin, Texas that has seen 30% growth in a year, it's hard to not pursue that. So for me, there's a couple criteria. It has to cash flow. I don't set a number. I don't need $300 a month. I have to cash flow. That's my main criteria. And so I'll run through the numbers on this one. And so my wife, God bless her, has allowed us to live in houses for a year, get primary financing, and then turn those into rentals. And so we've rinsed and repeated that cycle 3 times. And so here are the numbers on my current primary house that I bought in 2020, May of 2020. I bought it for $295,000, put 10% down, so $29,500. it just appraised 1 year later for 515. And so I was able to refinance that house and eliminate my mortgage insurance. And I pulled out $150,000 out of that house. My new mortgage on that house is $2,300, and I can rent that house for about $3,200 day one.
Wow.
And so when you get wins like that, it makes it really hard to not have appreciation markets as an emphasis in my investment strategy.
Now, let me play devil's advocate for a minute, because I mean, obviously, we've been in a really good market for the last couple of years, and everything has appreciated. But if, say, we enter a market, who knows, maybe later this year or next year, I mean, who knows what's going to happen? But at some point, if we enter a market where the prices aren't appreciating, or maybe they go down a little bit, is that going to make it harder for this to work?
For me, I've never cared. I have a higher risk tolerance than most, but I don't care what my house is worth from year to year. What I care is, what is my mortgage payment, and will my tenant be able to service that debt? That is the only thing that matters to me. And so if you look on that example I just gave, my mortgage $2,300, I can rent it out for $3,200. I've got a lot of cushion there, where if the market resets 25%, where even if I'm getting just $2,300 on my rent, I'm still covering my mortgage and somebody's paying off a house for me.
Totally. So on that first example you gave, the house that you bought for $229, that you have rented for $1,750, how much is your mortgage payment on that property?
It is $1,450 plus 30 HOA, so I'm at $1,485.
Okay, so you've got a few $100s there. So like you said, if rents come down, or if things break in the house, or you need to paint at some point, you've got some extra money. So with the extra cash flow that you have, are you just putting that aside for when stuff comes up?
I have a pretty healthy reserve budget, but I just, when I look at the inflation that we're all experiencing right now, I have a hard time just leaving cash in an account and letting that erode over time. And so I always keep a minimum of 3 months of reserves for every single property, that if they're all vacant for 3 months, I'd be covered. But then I also have other investments that I believe in, and that I could always tap into those if there was ever a crisis. And so for me, some are riskier than others. I have a cryptocurrency portfolio that I invest heavily in, also individual stocks, and just a dividend portfolio. For me, I'd rather stick the money in that pretty conservative dividend portfolio and get my 3 to 4% return on that, or just a high interest savings account. I can live with that if I just have money getting some appreciation.
Sure. And, I think the other thing to point out too is, historically over time, rents are going to increase. Like, it's rents coming down. Sure, it's happened, but it's very rare. So I think there's a better chance that a property that you have rented for $1,750 in a couple of years, or maybe even next year, might be renting for $1,900. I think there's a better chance of that happening.
Yeah, I mean, that's what I'm betting on. Everybody on all these shows, they're always looking for these off-market deals. They're looking for this, perfect burr property that you can buy undervalued, and it's just not what I'm looking for. For me, I'm betting on real estate long term, and I always will. And so I have such an array of properties. I've done a condo, I've done single family, I've got an Airbnb, I've done multifamily, I've done all of it. And the one common theme is if you hold it long enough, the numbers will make sense.
Yeah, absolutely.
And so, and I also it's just about not selling. You just can't ever be in a position where you're distressed and have to unload a property. And you have to put yourself in a position where you look at the economics of the real estate market at that time. And if you see an opportunity to refinance, you refinance. If you're in a distressed position and you have to sell, that's when you take losses, and that's when the numbers stop making sense.
Sure. If anybody is interested in connecting with Zach, I've got his email address on the website. Zach is also a full-time realtor, and if anyone is interested in investing in Austin, I would definitely recommend reaching out to Zach. I think he would be a great resource for you. I've got his email address at rentalincomepodcast.com/episode 353. I'd like to thank today's sponsor for making this episode possible. It's Chaley Ridge from Ridge Lending Group. Chaley is a nationwide lender, and her specialty is helping investors finance rental properties. She has a ton of different loan programs, and she can find something customized to you for your situation. When you talk to Chaley, also ask her about her no-doc loan, where she's just going to look at the deal. She's going to see if the numbers make sense, and if they do, she'll give you a 30-year fixed-rate mortgage with no documents required. She doesn't need your tax returns, pay stubs, bank statements, any of that. She's just looking at the deal. If you want some more information, you can reach out to Chaley at ridgelendinggroup.com, NMLS 42056. Thank you so much for listening to the podcast today. If this is your first time here, we put out new interviews every single Tuesday. And if you follow the show, you'll get notified as soon as they come out. My name is Dan Lane, and this has been the Rental Income Podcast.